Welcome to McGraw-Hill Financial's March Loan Market Overview clip. I'm Steve Miller, a member of MHF's Leverage Commentary and Data team. This month we'll discuss how loan demand continues to overrun supply, causing trends to move in an issuer-friendly direction. For real-time updates, please follow LCD on Twitter, Facebook, and LinkedIn. As well, you can download this presentation on slideshare.net. Before we start, here's our standard disclaimer. In February, new issue volume soared, but there was little in the way of new money deals. As a result, the loan market's technical equation tilted further towards issuers. The market's strength was driven in part by record inflows into the loan mutual funds, which reached $8 billion in February, according to Lipper FMI. As well, accounts had little new supply on which to spend these dollars, as M&A-related activity remained slow. With this in mind, new issue clearing spreads narrowed to a post-credit crunch low, igniting a rash of loan repricings that cut the spread of 9% of the S&P LSTA loan index during the first 2 months of 2011. By the end of February, the market appeared to have reached an equilibrium point. The reason is twofold. First, of course, was the uncertainty created by geopolitical strife in the Middle East and the consequent increase in oil prices. The second, ironically, is the fact that technical conditions got so strong that issuers extracted some of the excess yield in the market through repricings. This cooler trend is reflected in the February loan return numbers, which fell to 0.47% from 1.97% in January. That the market is seeing such inflows, in part, is a reflection of today's benign credit environment. With the economy on firmer footing and cash flow growing across corporate America, default rates have fallen well inside the historical average. This chart illustrates today's supply-demand imbalance. Without much M&A-related volume to restock portfolios, the amount of institutional loans outstanding continues to shrink even as inflows grow. Looking ahead, most participants see little changing in the near term. Start with the supply side. At first blush, the forward calendar of visible loans ended February at a bloated $31 billion, a post-Lehman bankruptcy high. On closer inspection, however, the plot thins, with just $6 billion of this amount slated for M&A purposes. If this is all there is, it will be unlikely to keep pace with demand. As mentioned before, secondary prices continue to hover at post-2007 highs, but the repricing trend has taken some of the heat off the market as investors pull in par-plus loan bids in anticipation of spread-cutting activity. As well, there is the strife in the Middle East that has put a damper on all capital markets. These charts show the extent to which the new issue market has moved towards issuers. Flex activity was nearly one-sided in February, with new issue clearing yields pushing below 6% for the first time since the market reopened in September 2009. Another consequence of hot market conditions is the covenant-light renaissance. So far this year, a quarter of all deal flow has cleared the market without maintenance tests, equal to the prior high from 2007. Accounts may not like it, but given the fact that covenant-light loans fared no worse from a default perspective in recent years, accounts are generally willing to concede covenants to preserve allocations for the most desirable situations. In February, decent economic conditions and muscular cash flow growth pushed the lagging 12-month default rate to a near 3-year low of 1.27% by principal amount. Managers expect default rates to remain low over the next 12 months, assuming, of course, that the market is not roiled by an outside shock. Of course, that caveat has become more than just a pro forma throwaway in recent weeks as a result of the ongoing events in the Middle East and their effect on oil prices. Outside of these factors, the market's fundamental condition remains strong. Upgrades continue to run ahead of downgrades, and leveraged loan issuers are generating fat cash flow increases. We'll wrap up with some final points. To the disappointment of collateral-starved accounts, LBO activity remains scarce. The challenge, participants say, is that sellers want to price deals off of 2012 EBITDA forecasts, while buyers are trying to buy properties off of far lower 2011 estimates. That has limited deal-making and put the focus of loan activity on recaps, refinancings, and repricings. In early March, the market reached an equilibrium point with spreads down as far as they can go on technicals alone and secondary prices coming under pressure as a result of broader market conditions and widespread repricings. In addition to bountiful liquidity, the market continues to benefit from strong fundamentals. In that regard, default rates sank further in February and look likely to do so in the months ahead. Well, that brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video below. As mentioned, you can also download this presentation at slideshare.net.